If I gave 10 people $100,000 each to invest in real estate, chances are they'd all invest it differently. Some would buy a rental property, others would just slap the money down on a principal residence, others would invest in a REIT, some would lend money through a mortgage investment corporation or a MIC, others would invest in land or development projects. So which approach out of all of these is actually right? And the truth is, and we all know, there isn't one best real estate investment. Each strategy is designed to accomplish something different. Some prioritize steady income. Others focus on long-term appreciation. Some offer liquidity and flexibility, which is important, while others require patience but may offer greater upside. So today, I'm going to walk you through 5 major ways to invest in real estate, explain the advantages and disadvantages of each, and help you determine which strategy might best fit your financial goals. So let's get into it. And if you're new to the channel, well, welcome. And if you're not new, well, welcome back. My name is Belanger. I help people make smart real estate decisions. I have various licenses, both residential and commercial, as well as private market investments, which we're going to talk about today. So let's get into it. And as we go through the various options, I want to come at it from a lens of diversification. It's important to diversify at least a little bit so that we're not heavy into one specific asset class. That introduces, theoretically, a little bit more risk. So let's get through it and think about potentially merging 1, 2, or 3 of the various options over the course of time. The first one is one of the easiest ways to invest in real estate. The first one is a REIT, or a real estate investment trust. And this is a company that owns and manages income-producing real estate. So instead of purchasing a property yourself, you're buying shares in a professionally managed portfolio of properties. That portfolio might include apartment buildings, office towers, industrial warehouses, retail centers, if you believe in that, hotels, data centers, healthcare facilities, and so on. And one of the biggest advantages of a REIT is diversification. Rather than relying on a performance of a single property, you're invested in hundreds of properties or even thousands of properties. These properties are managed by, like I said, professionals. And many of the REITs also pay regular distributions, making them attractive for investors looking for a little bit of passive income. And another major benefit is liquidity. This one is important because many REITs trade on public stock exchanges. You can generally buy or sell investments whenever the market is open. So of course, the advantages of that is a diversified portfolio, professional management, passive investment, easy to buy and sell, and it's accessible with relatively small investments. And the disadvantages: limited control, market volatility, sensitive to interest rates, returns depend on market performance, and all of this from this category is best suited for investors who are looking for a little bit of diversification, yes, passive income, and flexibility. And by flexibility, I mean more on the ability to liquidate your assets. And option number 2 is a mortgage investment corporation, or a MIC. And the second option works very differently. So instead of owning real estate, a mortgage investment corp, or a MIC, lends money secured by real estate. So think of it this way: you're becoming the lender instead of the owner. So developers, builders, and property owners borrow money. They pay interest. That interest is distributed to investors. So unlike a REIT, your return comes primarily from lending income rather than property appreciation. And MICs can be an attractive option for investors looking for passive income without managing tenants and/or properties. However, capital is often committed for a period of time, meaning that the liquidity, or the selling, is much lower than publicly traded investments. So the advantages from this side is that there's attractive income potential, it's passive investment, diversification across multiple mortgages, and the security is backed by real estate. And the disadvantages is that there's lower liquidity, like harder to sell, the borrower default option or the borrower default risk. The capital may be committed for several years, and performance affected by lending conditions. And this investment is best suited for investors focused on generating passive income who understand lending risks. All right, so let's move into ownership. So the third option is land syndications, and a land syndication allows multiple investors to pool their capital to purchase land with long-term appreciation potential. So instead of buying land yourself, you're investing alongside many other investors. And the investment thesis is usually pretty straightforward. Purchase strategically located land, wait for growth, and then as the infrastructure expands, communities grow, and zoning changes occur, and the land may increase significantly in value. And when the property is eventually sold, investors participate in that specific appreciation. So unlike REITs or MICs, you're investing in a specific project. That creates greater upside, but it also creates greater concentration risk. These investments generally require patience because it can take several years before an exit occurs. And of course, the advantages of this is strong appreciation potential, direct ownership exposure, passive investment, and opportunity to participate in long-term growth. And on the disadvantages side, well, you've got limited liquidity, capital is committed for several years, there's no guaranteed income, project-specific risks, and it's best suited for long-term investors seeking growth and willing to wait for that appreciation. Option number 4 is development projects. Development investing takes things at a whole other level. So instead of purchasing existing real estate or simply owning land, you invest in creating something that's entirely new. And that could be residential communities, apartment buildings, mixed-use developments, commercial buildings, industrial developments. Investor capital helps move a project from planning and approvals through the construction and ultimately the completion. If a project is successful, investors participate in the value created throughout the entire development process. And these opportunities can offer significant long-term growth potential. However, they also involve additional risks. There's approvals required, construction, financing, market conditions. Every stage must be successfully executed. And development projects also tend to have longer investment horizons, making them better suited for investors with patience and a long-term perspective. And the advantages from a project-based investment like this is you have significant appreciation potential, participation in value creation, you're participating in that creation, professional project management, and you have access to larger institutional quality projects. On the other hand, the disadvantages, there's higher execution risk, longer timelines, limited liquidity, and returns depend on successful project completions. And these types of investments are best suited for experienced investors with longer investment horizons, like we just talked about, and who are comfortable with higher risks in the pursuit of greater long-term growth. And the fifth option is one that most people already know: buying real estate directly for yourself, whether it's your own home, a rental property, an apartment building. Yes, you can buy apartment buildings, office space, retail property, or an industrial building. Direct ownership gives you the highest level of control. You decide what to buy. You decide how to finance it, whether or not to renovate, how to manage it, and when to sell. And many investors appreciate the opportunity to generate rental income while benefiting from long-term appreciation. We all know that. But of course, ownership also comes with responsibility, and lots of responsibility. There are maintenance issues, vacancies, financing, repairs, property management, tenant issues. It's more of a hands-on investment, but for many people, it's still one of the best long-term wealth building strategies that are available today. And the advantages are pretty obvious. Complete control, that's the big one. Rental income potential to help you offset some of the costs. There's long-term appreciation, which gets automatically sort of added to the entire equation. There's financing available, and there's tax planning opportunities. Sometimes it has tax advantages when done properly. And on the disadvantages side, well, it's active management, larger capital requirements, ongoing maintenance, vacancies, and tenant risks. Those are obviously pretty huge. And there's obviously a huge time commitment. And this type of investment is best suited for investors like you and I who want complete control and long-term wealth creation that are comfortable actively managing the real estate project. So how do these sort of options really compare? What I do, just pause the video here, take a look at this matrix, and the important thing to remember is this. Each investment solves a different problem. REITs offer flexibility and diversification. MICs focus on generating income. Land syndications focus on long-term appreciation. Development projects focus on creating value. And traditional ownership provides control, income, and appreciation. There isn't a universally best investment. There's only the investment that's best for you on your specific wealth journey. All right, so we just covered 5 very common real estate sort of options or categories. And what I want to say now is we all know people, I know people who are heavily concentrated in investments. So let's say the stock market, for example, and that's all fine. And I know a whole bunch of other people who are super concentrated in nothing but real estate investments. And it's important to have, obviously, your circle of competence. That's all fine. What I'm proposing or suggesting in this video is that we all have access to RRSPs, TFSAs, and LIRA, so registered money and unregistered money. When you take your registered or unregistered money, you can diversify your investments just a little bit. If you're heavy on stocks, slide 10% and find some specific real estate categories where you can diversify your investments. Same thing is true on the real estate side. If you're nothing but real estate, you might want to diversify and take a portion of that money and slide it over into something that is more liquid, a little bit safer. So again, contemplate things like mix or land syndication or whatever. The goal is a little bit of diversification and to have something in a couple of different categories. That's the point. And for each of these categories and even more categories, through the exempt market dealing space, we have dozens of potential products or investments under each of those categories, and we can evaluate each and every one of them. We can compare 10 different mix, 10 different mixed-use buildings, 10 different land syndications, and so on. You have farmland if that's what you want. Like there's a whole bunch of different options. My point is to diversify just a little bit, which might be a prudent sort of tactic to take in investments. One of the things that makes my business a little bit different is that I don't just help clients buy and sell homes, which of course is a huge component of my business. But as I mentioned off the top, I'm a licensed residential as well as commercial real estate agent. I'm also a licensed exempt market dealing representative for the private market investments. That allows me to help my clients explore opportunities across the full spectrum of real estate, from purchasing a home or a commercial property to private investment opportunities like mortgage investment corporations, land syndications, and development projects. And one thing I've learned over years is that the best investment isn't necessarily the one with the highest potential return. It's the one that aligns with your financial goals, your timelines, your need for liquidity, and your tolerance for risk. Many of the most attractive opportunities never appear on MLS or public websites. They're offered privately through trusted relationships and professional networks. And that's why, as usual, I always recommend starting with a conversation. Once I understand what you're trying to accomplish, I can help you identify which category or combinations of categories may be the best fit for you. Whether you're buying your first home, investing in commercial real estate, looking for passive income, or exploring private real estate investments, I'd be happy to help you understand your options. And if you found this video helpful in some small way, I'd appreciate if you'd subscribe and of course forward it on to anybody that you might think might find value in this video. So again, I appreciate the time, I appreciate you watching this, and as usual, I look forward to putting these videos together on a weekly basis. So until the next video, stay smart, stay invested, and I'll see you in the next video.